Welcome back to Talking Shit with KING-KAMBUF. Today, we are diving into a day that, honestly, it just perfectly encapsulates the current market anxiety,
Oh, absolutely.
the volatility, the sheer unpredictability of it all.
Mm-hmm.
And we're not just going to be summarizing headlines today. We're going to tear apart the detailed analysis in the reserve of KAMBUF Financial News and Reports Magazine daily report.
Yep.
Specifically, we're zeroing in on the data from Thursday, November 20, 2025.
And that specific report is it's fascinating because November 20th was a textbook study in mass institutional psychology.
It really was.
It was one of those days where, logic just seemed to fail and panic took over.
So our mission today for you is to really get past those simple closing numbers.
Right. We want to understand the colossal intraday shift, both emotionally and in terms of capital, that just completely wiped out what looked like a genuine market recovery.
A recovery that so many people were banking on that morning.
They really were.
And when we say a shift, this isn't, some minor fluctuation. We are talking about a true volatility trap. The central paradox of this day is almost unbelievable.
It is.
You have the Nasdaq Composite, the big tech bellwether, just soaring in the morning.
Trading up over 2% at one point.
Exactly. And it was all fueled by what should have been unequivocally great news from, the engine of the entire AI economy.
But then the bottom just dropped out.
Completely.
By the time that closing bell rang, all that incredible morning momentum wasn't just gone.
It was reversed.
Violently reversed. The Nasdaq finished the day down a staggering 2.2%.
That swing is just massive.
It's a huge event. I mean, you're talking about a move of over 4% from the intraday high to the closing low. Reports confirm this was one of the largest and, frankly, most demoralizing intraday reversals we've seen in a long, long time.
It rivals the chaos we saw back in, April 2024?
That's the one. It has that same feel to it.
And that kind of whipsaw action is just devastating for investor confidence.
It is.
It signals that every piece of good news is being met not with enthusiasm, but with suspicion.
With skepticism. It tells us that investors are using any strength, any rally, as an exit ramp.
Not an on-ramp.
Precisely. They're selling into strength, not buying the dip.
Okay, let's unpack this. Let's quantify the damage, starting with the three major indices.
Right, because when we dissect the index performance, you can see exactly where that selling pressure was concentrated.
And it was broad, wasn't it?
Oh, it was broad. 10 out of the 11 S&P 500 sectors closed lower. But the epicenter of the destruction, once again, was technology.
The Nasdaq Composite, as we said, took the worst hit. It plunged 2.2%. And this wasn't just a one-off bad day.
No, this was piling on. It was extending an existing 4-day losing streak, which turned what was a mild slump into a very, very serious technical concern.
And for those of you tracking the charts, the report really highlights the immediate danger zone.
It does. It points to that crucial technical support level for the Nasdaq at 22,000.
And that 22,000 level isn't just some arbitrary line on a chart, is it?
Not at all. It represents a key psychological barrier. It's a significant confluence of moving averages. It's a point where a lot of institutional models have their line in the sand.
So if that level breaks...
If institutional selling pressure breaches 22,000, you could see a cascade effect.
Triggering stop losses.
Exactly. Triggering automated selling, accelerating a move lower toward the next major support zone, and, potentially opening up a path all the way back to the lows we saw midsummer.
And the fact that the market couldn't hold on to any gains, even with incredibly positive news, just reinforces that institutional holders are playing defense.
All defense. It's all about capital preservation right now, not offense.
Okay, so let's look at the broader market, the S&P 500.
Right. The benchmark fell 1.6%. It closed just a hair above 6,535.
And that daily drop put the S&P firmly on track for what could be its worst November performance since 2008.
Since the financial crisis, yeah.
That comparison alone should really grab your attention.
It should. And critically, the immediate technical support range for the S&P 500 is very, very tight. We're talking 6,500 to 6,500.
And it closed right at the bottom of that band.
Right at the bottom. And what that means is that we are really testing the patience of the buyers.
It's a make-or-break level.
It is. A failure to hold 6,500 signals that the macro concerns, and we're talking chiefly about the Federal Reserve's prolonged high-rate environment, are structurally outweighing any positive stock-specific fundamentals.
Which creates an environment just ripe for more correction.
Exactly.
Interestingly, though, the Dow Jones Industrial Average, which is, structurally different.
Much less weighted toward mega cap tech.
Right. It's more industrials, more defensive names. It actually managed to show some relative stability.
It did. It was down, but only a modest 0.8%, closing around 45,751.
And this divergence, this is really the first clearest piece of quantifiable evidence of that massive sector rotation we keep talking about.
It's a perfect illustration. Investors are ditching the promise of future growth for the security of established, profitable value names.
And that rotation naturally leads us to the VIX.
The VIX explosion, right.
Sure.
The CBOE Volatility Index, or VIX, whatever we call it, the market's fear gauge.
Can you just quickly remind us what that's measuring?
Sure. It's a direct measure of the market's expectation of 30-day volatility. It's all derived from the pricing of S&P 500 options.
Yeah.
It's what the big players are willing to pay for insurance.
And on this day, the VIX finished elevated.
Very elevated, 23.66. That's a sharp 10% jump in a single day.
And it spiked pretty rapidly, right? It wasn't a slow creep up.
No, it jumped from that calmer 20 handle in the morning all the way to the mid-20s intraday. And that just clearly signifies that investor anxiety is intensifying and fast.
So let's put that number 23.66 into context for everyone.
Okay, so the 20 to 25 range is already what we define as elevated anxiety.
So we're already there.
We're already there. At 23.66, we are knocking on the door of the high fear range, which historically kicks in around 25 to 30.
And what does that mean for the actual mechanics of the market, for the options market?
Well, more importantly, it means the cost of hedging, the cost of buying that insurance, goes up dramatically.
As puts get more expensive.
Puts get much more expensive. This shift in the VIX curve means institutional desks are paying a serious premium for downside protection, and that reflects their real-time belief that sharp swings, likely downward, are coming.
So what does this level of implied volatility mean for you, the listener, when you're planning your strategy?
It's actionable information because the VIX translates directly into expected movement.
Okay.
Our reading of 23.66 signifies that institutional investors are anticipating the S&P 500 will swing somewhere between 6.8% and 7.5% over the next 30 days.
Wow.
So if you translate that into actual index points, based on the closing level, it suggests a potential trading range for the S&P 500 between, say, 6,100 on the low end and 7,100 on the high end.
That is a 1,000-point range. That's vast.
It's massive.
And that width, that suggests a kind of institutional paralysis, doesn't it? If the projected trading band is that wide, portfolio managers become really reluctant to deploy significant capital.
Of course. They fear they might be buying the top of a massive intraday move. Or worse, trying to catch a falling knife.
So nobody wants to be the first one in.
Exactly. And furthermore, when volatility spikes, something called options skew, the relative pricing of puts versus calls, it shifts dramatically. Puts become much, much more expensive relative to calls.
Confirming that downside bias.
It confirms the market is structurally biased toward anticipating downside risk. This VIX reading, it's not just an indicator, it's almost a self-fulfilling prophecy of market nervousness and structural defensiveness.
Okay, so let's pivot to the central mystery of the day.
The NVIDIA paradox.
The massive reversal driven by NVIDIA. The optimism that fueled that morning rally was palpable, and it was all centered around their earnings.
The pre-market activity was just overwhelmingly bullish. You look at the Nasdaq Q100 pre-market indicator, a key gauge of tech sentiment, it was up a massive 459 points.
It's huge.
And NVIDIA, which had reported after the bell the previous day, was the undisputed star. It was trading way higher pre-market at $195.95. That's a jump of over 9.4%.
And it wasn't just a tech story either, which I think is important.
That's a great point.
Walmart also reported, and they confirmed the surprising strength in the consumer and retail sector. WMT shares were up, 6.5% pre-market?
6.53%, yeah. So you had these dual signals of health. The future of computing AI was booming.
And the present-day consumer was resilient.
Exactly. Every single indicator pointed toward a market relief rally.
And yet the market narrative completely imploded. This is where we need to dive deep into the specific disappointment.
Right.
Despite NVIDIA reporting a positive EPS beat and raising their forward guidance.
Which are the two highest conviction fundamental signals a company can give you.
Right. The stock closed down 3.15% at $180.64.
It's just brutal.
How does that even happen? How does a company exceed expectations, raise the bar for the future, and then get immediately punished for it?
That is the question institutional investors were trying to answer all afternoon. And the report gives us a few key insights that go beyond just, generic skepticism.
Okay, so what's the primary analysis?
It points to the sustainability of the AI spending spree. The market's focus shifted from celebrating the current quarter's beat to questioning the next 3 quarters.
So it's a long-term view.
A very sudden shift to a long-term view. Specifically, the source highlights skepticism about AI ROI and broader tech and AI capital expenditure concerns resurfacing.
So the worry wasn't about NVIDIA's current products?
Not at all. It was about the lack of visibility into Q4 and Q1 order commitments from their mega-cap clients.
The Alphabets, the Microsofts, the Metas.
Exactly.
So the concern is concentration risk layered on top of sustainability risk.
That's it, perfect.
These massive data center expenditures, they're concentrated among just a handful of buyers. So if one or two of those customers even hints that they're reaching capacity or throttling back,
You get an immediate massive air pocket in demand. That's the fear.
I see.
And furthermore, specific institutional models probably flagged an underlying concern about gross margins, even if the headline number was fine.
How so?
Well, the intense competition in the AI chip space, plus the higher costs of securing advanced manufacturing capacity, it means the rate of margin expansion might not have met the sky-high expectations that were already baked into a $195 stock price.
So the market basically decided that the easy money had been made?
Precisely. And that the risk of a slowdown or even margin compression in 2026 was just too high to justify that valuation.
And that conviction led to massive repositioning, which is so obvious when you look at the volume leaders list.
Yes.
This wasn't small investors getting spooked.
No, this was institutional activity through and through. The volume tells the true story of the whipsaw.
Mega-cap tech names just dominated the list.
Microsoft, NVIDIA, Alphabet, Amazon, they all saw trading volumes that vastly exceeded their 90-day averages.
And NVIDIA alone.
NVIDIA alone saw over 175 million shares change hands.
Wow.
This high volume confirms that large, influential players were driving that reversal. It was this collision of disciplined profit-taking with short-term panic selling.
And because the Nasdaq is so heavily weighted toward these few names, the concentration risk is just unavoidable.
It's a structural vulnerability.
When NVIDIA, Microsoft, and Google are all being actively sold, the entire index gets dragged down, regardless of how well smaller or defensive stocks are doing.
And that massive decline in those concentrated holdings, that's what amplified the VIX spike, which then confirmed to the market that when the leaders falter, the indices have to follow.
Making the Nasdaq's failure to hold 22,000 all the more ominous.
Exactly.
So this intense pressure in the tech sector created what you could call a dramatic tale of two markets.
This is the perfect way to describe it.
This extreme divergence, where growth stocks are just hammered and defensive stocks thrive, that is the hallmark of a true risk-off rotation.
It is. Investors are selling abstract promises and they are buying tangible stability.
The flight to quality was just crystal clear.
Clear and pronounced. The top gainers list, it looks completely uncorrelated to the dominant technology narrative of the last couple of years.
Walmart led the entire market. It surged 6.29%. And this performance wasn't just about beating estimates, was it?
No, it was driven by that raised FY 2025 guidance. That suggests consumer demand is durable, even if shoppers are prioritizing value.
Which demonstrates an active, conscious decision by the market to favor established profitability over growth promises.
That's the key phrase from the report, and it's dead on. And we saw this preference for defense across multiple sectors.
Like healthcare.
Healthcare, a classic recession-resistant sector, showed significant strength. Regeneron, REGN, was up 5.1%. GE Healthcare, GEHC, gained 2.3%.
Because people don't stop needing medication or medical services just because the economy gets shaky.
Exactly, which makes these companies very attractive when fear is high.
The report also noted strength in some highly diversified and industrial names. For example, Berkshire Hathaway Class B shares gained over 2%.
2.22%. And that's often seen as a proxy for conservative value investing.
And the industrial segment had a surprising winner.
It did. SOLV.
Solventum. Listeners might not be immediately familiar with that one.
Right. Solventum, which primarily deals in industrial and diversified healthcare solutions, showed this really underlying resilience. It even earned it a strong buy designation in a technical analysis we'll get to later.
And its performance just highlights that the rotation is seeking stability across all sorts of sectors, as long as the fundamentals are divorced from those high multiple growth expectations.
That's the key.
On the other hand, the top losers list is just a brutal reminder of the penalty for high valuations in a tightening monetary environment.
It's a bloodbath. The semiconductor sector was a bloodbath, and it effectively negated any positive spillover from NVIDIA's strong report.
Micron Technology, MU, dropped. What was it?
A whopping 9.7%. And Western Digital, WDC, fell 7.79%.
And the sources attribute this to memory chip concerns. Why is that so critical?
It's critical because it suggests that while the hyperscalers are still buying NVIDIA's high-end AI chips, the broader memory market might be facing an oversupply or slower enterprise adoption outside of that top tier.
Which puts pressure on pricing and inventory for players like Micron.
Correct.
And then you have the high-growth software and financial tech names, the ones that are really dependent on aggressive future cash flow discounting. They were just eviscerated.
Robinhood, H-Hood, plummeted 9.54%. Datadog, DDOG, dropped 8.67%.
And these are the stocks that are most sensitive to interest rate expectation.
They are. When the Fed signals an extended period of elevated rates, the value of those future cash flows gets brutally discounted back to the present.
And that leads to immediate, intense selling pressure.
It confirms the market is now pricing in a higher-for-longer scenario for the benchmark rate.
We can really quantify this whole rotation through the sector weighting analysis.
We can. Technology was the single worst performer, down to punishing 3.2%. Communication services was right behind it at minus 2.1%.
But then you look at the bright spots.
And they tell the other half of the story. Consumer discretionary, which was lifted almost entirely by Walmart and some other retail strength, was up 1.5%.
Consumer staples gained 0.8%.
And utilities rose 0.2%. The sheer magnitude of the loss in tech relative to the modest gains in defensive sectors confirms the entire index damage was caused by institutions rotating out of just a few heavily weighted names.
So it's a market breadth issue.
A huge market breadth issue. A few stocks are carrying the burden of the many that are collapsing underneath the surface.
To really understand why that positive morning momentum just dissolved, we have to shift our focus to the macroeconomic drivers.
Right. And the jobs report, the September employment data that was released on November 20th, there was the crucial catalyst that spoiled the party and really fed that afternoon reversal.
And the data was just frustratingly mixed. It's the kind of data that paralyzes the Federal Reserve and terrifies the market.
That's a great way to put it. Non-farm payrolls came in significantly hotter than estimates.
119,000 jobs added versus a 50,000 estimate.
Right. That level of hiring resilience suggests a very strong, possibly even overheating economy.
But here's the confusion.
Here's the confusion. Simultaneously, the unemployment rate ticked up. It rose from 4.1% to 4.4%.
Okay.
And crucially, average hourly earnings continued to climb, which is the Fed's #1 inflation concern right now, that wage price spiral risk.
Wait a minute. So if employment is strong, that's inflationary, which would argue for the Fed to keep rates high.
Correct.
But if the unemployment rate is rising, that signals stress, which would argue for the Fed to ease up. This is a mess. So why did the market react by selling off growth stocks? Why didn't it focus on the rising unemployment as a signal for potential rate cuts?
And that is the core of the issue. The market tends to prioritize the strongest signal in a mixed report.
And in this case, that was the inflation signal.
In this case, the combination of strong NFP and persistent wage growth completely overshadowed that slight tick up in unemployment.
So the takeaway was, the Fed's job isn't done.
The Fed's job is unfinished. The immediate implication priced into the market was that the probability of a December rate cut just plummeted.
And the consensus shifted to an extended period of elevated rates is highly likely.
And that realization hits growth stocks, your NVIDIAs, your Datadogs, your Robinhoods, like a lead balloon.
Because their massive valuations depend on cheap capital.
Exactly. If rates stay high, those distant future cash flows are worth much, much less today. That realization alone provided the perfect excuse for institutions to dump their tech holdings, regardless of how strong the NVIDIA report was.
Now, the bond market check provided its own peculiar signal.
It did. Treasury yields actually declined across the curve. The benchmark 10-year yield dropped 0.15% to 4.0.
Now, typically, lower yields are positive for stock valuations. They reduce the discount rate.
That's right.
So if yields are falling, why did the stock market crash? Isn't the bond market signaling some kind of distress that the Fed should address?
It's complex. But in this specific volatile context, the falling yields were interpreted as a flight to safety.
Not an endorsement of lower rates for stocks.
Not at all. Investors were moving capital out of risky equities and into the perceived safety of government debt. It was about geopolitical concerns, domestic economic uncertainty.
So this risk-off mood in the bond market just reinforced the pessimism in the equity market.
It acted as a negative feedback loop, absolutely.
And finally, we have to talk about the crypto correlation, which is just a fantastic barometer for overall risk appetite.
It really is. The crypto market serves as a high beta proxy for the technology sector. And on November 20th, it flashed a huge warning sign.
Bitcoin dropped 3.5%.
To 86,337 levels. And that hit a painful 7-month low. This drop was consequential because it immediately accelerated the selling in crypto-related equities.
So you saw Marathon Digital, Coinbase, MicroStrategy.
All down 7% or more. It was a chain reaction.
And the report highlights a specific technical risk threshold here that concerns volatility managers.
Yes. The market is keenly watching the $85,000 support level for Bitcoin.
Why is that level so important?
If Bitcoin breaks decisively below 85K, it significantly raises the potential for margin liquidation risk.
Yeah.
Because so many aggressive hedge funds and retail traders use leverage in the crypto space, a sudden drop can force liquidations not just in crypto, but across the broader risk asset landscape.
So it spills over into high-growth tech stocks.
It spills over. The crypto weakness was just confirmation that the overall appetite for any kind of speculation had deteriorated significantly.
So the market clearly panicked yesterday, and it reinforces that just relying on fundamentals alone is not enough right now.
No, not in this environment.
If we're entering a period of high uncertainty marked by an elevated VIX, you need a tactical plan.
You do.
And this brings us to the strategic analysis in the daily report, the TKIF 20+ analysis. Here's where it gets really interesting.
Yeah, this technical toolkit is designed to filter out all that noise and provide actionable entry points, targets, and stop-loss levels.
So for you listening, what does TKIF 20+ actually stand for?
It stands for the Technical Key Indicator Financial Engine. And the 20+ part signifies that the proprietary model places a heavy weight on signals derived from 20-day moving averages and a high-conviction momentum factor screen.
So it's a quantitative strategy.
It's a quant strategy designed to capitalize on technical breakouts, and in this case, defensive moves.
And based on this screening, the strategic investment recommendations for the week of November 20th to the 27th are highly concentrated in those defensive and value sectors.
The ones that resisted the tech collapse. No surprise there.
So we saw 3 strong buys that met the TKIF criteria.
First was Walmart, WMT, which confirmed its status as a defensive winner. It benefited from the strong earnings beat, the raised guidance, and a clear technical breakout that held up even while the indices were selling off.
Second was Regeneron, REGN.
Chosen for its reliable healthcare sector strength and very solid technical support levels.
And third, the one we mentioned earlier, Solventum, SOLV.
Selected for its industrial strength and its robust positioning in a diversified market. The rationale here is just crystal clear. The market rewards stability when fear is in charge.
And the report also recommends buys on some major financial and diversified stalwarts.
Yes, JPMorgan Chase, JPM, and Berkshire Hathaway, BRKB, are categorized as defensive yield plays.
So they offer stability, dividend yield,
and reduced exposure to the bleeding edge of tech speculation. FactSet, FDS, and GE Healthcare, GEHC, round out the buy list, which again highlights resilience in specialized software and medical tech.
What's equally instructive here is the caution that's applied to the massive technology holdings.
Oh, absolutely.
Microsoft, Amazon, and Apple, the foundation of so many modern portfolios, they were given a hold nibble rating, not an outright buy.
And that's a very important tactical signal for you, the listener. The rationale is explicit.
Which is?
While these companies possess immense long-term strength, they are facing massive tech sell-off headwinds right now. The advice is to wait patiently for stronger technical support to form.
Maybe a test of their 200-day moving averages.
Perhaps. Before committing significant capital, the TKIF analysis recognizes that even the strongest fundamentals can't override negative sector momentum in the short term.
We mentioned earlier that the analysis pinpoints the top 5 stocks with the best risk-reward spreads. This is crucial for navigating high volatility, right? Because it maximizes your potential gain relative to a defined loss.
And this methodology is so highly valued because it provides superior risk-adjusted opportunities. We're just looking at the potential, target minus entry versus the potential loss, which is entry minus stop loss. A high ratio indicates a very favorable setup.
And Walmart, based on its strong earnings, had the #1 ratio at 1:3. Let's break that down using the report's specific numbers.
Okay. The TKIF analysis suggested an entry point of $101, a price target of $110, and a defined stop loss at $98.
So if the trade works,
The potential profit is $9. If the trade fails and you get stopped out, the potential loss is only $3.
so you're risking $1 to potentially gain $3.
That 1-to-3 ratio provides a significant buffer, and is precisely what conservative and moderate investors should be seeking in volatile times. High confidence and tightly defined downside risk.
And the consistency across these defensive names is clear, with Regeneron right behind with a 1 to 2.8 ratio.
It reinforces the technical conviction behind this defensive rotation. These aren't just fundamentally safe stocks, they also offer technically sound entry points with high risk-adjusted returns.
Now, beyond strategic investment, the report also detailed some aggressive day trade projections.
Right, focusing on the high volatility names for those tactical traders who really thrive on those big intraday swings.
And NVIDIA was the primary focus, given the massive volume and that 4% intraday swing.
The projected intraday range for NVIDIA was set between $175 and $190. The setup was targeting either a counter-trend bounce play from the low 170s or a breakdown confirmation below the morning's selling levels.
And the volume was the key signal there.
Absolutely. 175 million shares traded. That signals deep institutional activity that creates repeated tactical opportunities.
Tesla was the secondary focus.
Identified as a strong support bounce opportunity near that critical $350 level. But, and this is important, these trades require extreme discipline.
So what's the key strategy recommendation?
It's tactical and it's defensive. For swing trades, you're looking at optimal hold times of maybe 2 to 4 hours. You're aiming for 3 to 5% targets. And absolutely crucial, your stops must be kept very, very tight.
Because with the VIX at 23.66,
The market can reverse 2% against you in minutes. That means precise stop-loss management is completely non-negotiable for anyone doing aggressive high-risk trading.
Okay, so having analyzed the chaos of November 20th and established a technical roadmap, the daily report concludes with a forward-looking 30-day outlook.
Right, and it assigns probabilities to near-term scenarios based on all those prevailing macro factors and the current technical posture.
And it is very notable that the bearish scenario is assigned the highest probability.
It is 50%.
And that reflects the current dominance of fear and structural uncertainty.
It does. The key risks driving this 50% likelihood are, first, the intensification of those AI bubble concerns we talked about, that realization that CapEx spending might be throttling.
And most importantly,
The Federal Reserve holding rates steady. If these risks materialize, the market correction would deepen toward the S&P 500 range of 6,200 to 6,400.
and the VIX would likely spike even higher.
Toward the 28 to 30 range, signaling full capitulation and extreme fear levels. The specific trigger could be a hot CPI report or a particularly hawkish statement from the Fed after their next meeting.
Conversely, the bullish scenario is assigned a 30% probability. What are the specific triggers needed to overcome all this pessimism?
For the bulls to regain control, we need a decisive policy shift. First, the Fed would have to clearly signal a high probability of a December rate cut.
Which would immediately remove the discount rate pressure on growth stocks.
Immediately. Second, the tech sector would have to experience a sharp, rapid, oversold bounce from these technically depressed levels. If that were to happen, the S&P would likely test the key resistance range of 6,600 to 6,700.
But that would require a quick resolution to those AI sustainability questions.
A very quick and clean one,
And the remaining 20% probability is for a sideways consolidation scenario.
where we just churn within a range of, say, 6,400 and 6,600, characterized by continued frustrating sector rotation between defensive value and beaten-down growth.
And this scenario analysis allows us to provide some highly tailored investment positioning based on your risk tolerance.
Exactly. For conservative investors, holding 40% stocks and 60% bonds or cash is advised. The focus here is exclusively on stable, dividend-paying defensive names.
The ones identified as buys, Walmart, Regeneron, JPM, Berkshire.
Right. Stability over potential returns is paramount.
For moderate investors, typically balanced at 60-40, they should be actively rotating.
The guidance is to significantly shift exposure away from concentrated tech and toward defensive and value sectors, using the technical support bounces identified in the TKIF analysis for precise entry points.
So using limit orders near those support levels.
Exactly.
And for aggressive investors who are maintaining an 80% stock exposure, the advice is to use these deep dips as tactical entry opportunities.
They should be focusing on those high-volume, potentially oversold, but fundamentally sound names like NVIDIA and Tesla. However, and this is a crucial caveat, these tactical entries must be managed with the tightest risk controls we discussed in the day trade section.
To manage the inherent risk in this 50% bearish probability environment, the report provides a practical, three-step risk management framework.
And these action items are critical for your portfolio's health. First, aggressively rebalance if you are overweight tech. November 20th was a giant expensive warning against concentration risk.
Second,
Actively monitor the VIX. If it breaks above 25, that signals the market is entering a fear-driven spiral, and portfolio hedges must be increased immediately.
and third,
Watch the S&P 500 6,400 support level. A decisive break there signals a structural shift and potentially a deeper, more systemic issue.
and what are the specific hedging tools recommended to cushion against that downside?
Well, to specifically protect that high-tech exposure, the report advises using put spreads on QQQ, which is the Nasdaq 100 ETF.
Can you explain what that is?
It involves simultaneously buying a higher strike put and selling a lower strike put. It provides protection up to a certain point while defining and limiting the cost of the insurance.
And for general volatility insurance.
The use of long VIX calls is suggested. The optimal time to get into that insurance trade is when the VIX briefly drops back below 20, which makes the cost of protection cheaper before the next inevitable fear spike.
So these are practical measures to offset that 50% probability of the market moving against you.
They are.
In conclusion, then, the events of Thursday, November 20, 2025, just vividly illustrated the current market's extreme vulnerability.
Extreme vulnerability to sharp sentiment shifts, all driven by this macro confusion, despite the underlying strength of the S&P 500.
Which is still tracking 8.5% year-over-year earnings growth for Q3.
Right, marking the 9th consecutive quarter of growth. That fundamental success is being completely paralyzed by persistent monetary policy uncertainty and that institutional skepticism about the sustainability of the AI spending frenzy.
It was a day that absolutely favored the agile, tactical traders who were able to pivot out of that morning rally and into high-conviction defensive names.
Not the passive die-and-hold investor.
No, the market is not rewarding patience right now. It is rewarding discipline.
And the current environment demands intense scrutiny. We're caught in this painful tension between current, strong corporate earnings and this paralyzing future fear tied to the Fed's path.
The confusion from the jobs data just amplifies this tension.
It does. And looking ahead, we have immediate key catalysts. The critical Federal Reserve December meeting, the release of crucial holiday retail sales data, and the inevitable year-end portfolio rebalancing flows.
All of which pretty much guarantees continued volatility.
Absolutely.
And that fear is just overwhelming the headlines right now. But let's step back for a second and leave you with this final thought drawn directly from the context we analyzed today.
Okay.
Despite the intense volatility and the massive institutional selling pressure in technology, firms like Barclays PLC remain overwhelmingly bullish on AI's long-term structural impact.
They do.
They see the productivity gains and market adoption as structural. They're raising their S&P 500 outlook for 2026 to around 7,400. That is a massive structural forecast.
It is. So the question for you, the listener, is this. How does the market's current fear-driven trading, where institutional desks instantly dump stocks even when they beat earnings, reconcile with that kind of aggressive, long-term structural optimism?
Where do you place your bets on the long-term AI trajectory? Is today's chaos a momentary pause before the ultimate technological boom? Or is it the first crack in the foundation?
A very good question to ponder.
Thanks for diving deep into the volatility with us. We hope this roadmap helps you navigate the weeks ahead.